Hello, good evening, everyone. Thank you for joining me as always. It's been a little while since I last live streamed with you all, so I'm looking forward to answering any questions that may have come in this evening regarding early retirement, financial independence, index investing. We can talk about buy to let property, whatever you wish. So, just quickly to let you know, I am not a financial advisor. So, obviously, I cannot give you any financial advice, but I'm more than happy to give my opinion and have a chat with you on this Sunday, rainy Sunday evening. So, yeah, any questions, leave them in the comments box and I will do my very best to answer them. So if you can all just let me know if you can hear me okay in the comments, I'll be really grateful. Hi to Glenn, who's joined us this evening from Glenn Russell Property and Finance. So yeah, the way tonight's going to work, I've got some set questions that I've been asked on the channel and on my Instagram account. I'm going to make my way through those questions and answer any that may also pop up over in the comments box. So don't forget, do fire away any questions you may have. Yeah, hi. Amid Finance, good evening. Good to see you, Gary. Nice to see you too. Mo, I believe, nice to see you. Restore with Cal, can hear you fine. Thank you very much. So let's get going with the first question while we're waiting to see if any more questions come in. So the first question was from Ryan Mason. And Ryan was commenting on one of my videos where I was speaking about the ETF VWRL. Hi Dawn, thanks for saying the sound is okay. I'm glad you guys can hear me fine. So Ryan's comment and question was on one of my videos all about the ETF VWRL, which some of you may well know is one of the main index funds or ETFs that I invest in. And he said, do you not think that the FTSE Global All Cap is slightly better and slightly more passive due to it being an accumulation fund? So I thought this was an awesome question, and I have to admit it is one I get asked all the time, so I thought I would include it in tonight's live. And to answer his question, yes, it probably is better, to be truly honest, because of the exact reasons he said. It's ever so slightly more diverse due to the fact it includes small cap stocks, whereas the VWRL is mid and large cap stocks only. And secondly, it is an accumulating fund. So what that means is any dividends that are paid out are automatically reinvested for us. Now, the great thing about that is it introduces something very exciting that we know as compound growth. Some people call it compound interest too. I would probably argue it's not really interest as such, but we won't need to argue about that. Basically, your growth is compounding, whether or not it be interest or not. So the answer to the question, yes, it probably is slightly better. However, you may well be asking, well, in that case, why do you invest in VWRL? And there are three main reasons why I invest in VWRL. Number one, when I first started investing in index funds, I was following quite a big UK fire blogger, and he suggested VWRL. So to be honest, there was a bit of following the herd. Number two, it is ever so slightly lower cost. So the ongoing charge, what we get charged for buying into these index funds for VWRL is 0.22, and the ongoing charge for the FTSE Global All Cap is 0.23. Now, don't get me wrong, with this 0.01 difference, it's probably not going to make hardly any difference over a 30 or 40 year investing horizon, but to me, it was a lower fee. And number three, VWRL has actually ever so slightly outperformed the global all cap over a long investing period. When you look on a sort of comparison chart on a website like Morningstar, you can actually see that VWRL has ever so slightly outperformed. So that's the reason why I personally choose VWRL. Again, it's not financial advice, but I don't really think you can go far wrong investing in either the ETF VWRL or the FTSE Global All Cap. So I hope that answers your question, Ryan, and thank you for an amazing question. I know it's one that I get asked a lot. So we're going to head over to the comments box quickly because I have had my first question in there from Amid Finance, which says, what do you think about investing in a clean energy ETF? So I don't think it's a bad idea at all. Thank you for a great question. It's clearly the way that we are going. We need to do something about sort of looking after our earth. So it's certainly something that is going to be quite popular, I believe. The only thing I would say, I have to admit, I don't put too much money into these sort of more um, what's the correct word? These more sort of dedicated funds, because my investing approach personally is a much more broad index sort of world tracker fund. But my personal thoughts about these funds are that they're great, and they're investing in something that we're all sort of heading towards. I know a lot of these energy companies now are aiming to be green companies. The only thing I would say is you're just starting to almost stock pick a little bit, because obviously they're having to pick these clean energy companies to be included in this ETF. But I don't think it's the worst investment you could make. I suppose the main thing I'd be checking is how many companies does it invest in. So is it a large index fund? Is it made up of thousands of companies, which gives us a nice diverse fund? Or is it made up with a small handful of companies, which maybe I'd worry about a little more? But thank you for an awesome question, and please keep them coming in the comments box. So we're going to head over to the comments, the sort of preloaded questions. Can you guys still see me okay? I need to pop over here. So back over to the preloaded questions. This one's from Jeremy. Jeremy. Sorry. I don't know what's going on with my pronunciation this evening. Hi Gary, great to follow you as always. Are you planning to increase your allocation to your ISA ESG Developed World All Cap Equity Index Fund by putting some more money in each month, or are you going to keep this ratio? So this to answer this first question, yes, I certainly am investing more into the ESG fund. I'm really quite a big fan of the new ESG fund. Like I was just answering in that last question to a mid finance, the nice thing about the ESG fund is it's still made up of I think 2 or 3 thousand companies, so it's nice and diverse, and it's just concentrating on the sort of companies that I would like to be investing in. It cuts out some of the stuff like maybe firearms and tobacco and things like that. Of course, there's a big argument with what you class as a good ESG stock may be very different to what I class as a good ESG stock. So I would say you need to double check what is included and whether or not that is the sort of correct balance for you. But yes, I will be investing more in that ESG fund. And then the second part of the question is also at the bottom. Also, I noticed that you are 100% equities. Are you not putting anything into your defence, like bonds or commodities? So no, I'm not. I am indeed in my investing in the stock market. I am indeed 100% in equities. Right now, I'm 31 years old, so potentially my investing sort of horizon is potentially as much as 40 years. And I do have an aggressive approach where I am 100% equities, because I'm definitely going for as much growth as possible. I do appreciate that when there are drops in the market, and it's important to realize there are going to be drops in the market, that these drops are going to affect me more. But because I'm constantly putting more money into my portfolio, I'm going to see these as good buying opportunities to buy stocks at reduced price compared to what I was a previous month before that drop. A second answer to this question, you have got to remember as well that although I invest 100% in equities in the stock market investing I do have quite a lot of investments elsewhere, one of the main one being buy-to-let properties. So that is maybe something else we can speak about in tonight's live. So if anyone has any questions to me about buy-to-let properties, please fire them away in the comments box. But thanks for a great question. So on to the next question in sent in by viewers. So the next question sent in by a viewer was this viewer was on Instagram and asked to stay private. But it's, how do you stay motivated with your FIRE journey with your lack of income over the last year? So just to explain to everyone that may be on the stream with us, for anyone that doesn't know, I am a wedding photographer. So obviously, with COVID going on, it has been a tough year and a half, really, due to the pandemic and weddings not being able to take place. So I'm actually going to flip this question almost on its head, and I have stayed motivated with fire. If anything, fire has motivated me to stay. Sorry, fire has helped me stay motivated during the bad times in my business. So it's almost worked in reverse for me, if that makes sense. The reason being is because I've thought about these things. I've thought about my finances. I've got these passive streams of income. I've got the rental properties paying me an income. It's made the last year and a half what could have been an extremely stressful and a very difficult time financially actually not too bad, because I did still have an income coming in. So it's actually made me so grateful that I've thought about these things. I've got these passive incomes coming into to me. So yeah, I know it hasn't directly answered your question, but I'd almost flip the answer on its head and say that fire has in motivated me to stay the course during what has been a very difficult time in my business. But thanks for your great question. So we're going to head over back to the comments, the live comments from tonight, because I can see another one from Trade M. So Trade M, who has a great Instagram account, by the way, so do go and check her out. Says, "Hi Gary, what are your thoughts on focusing mainly on an S&P 500 or global funds? I started off heavy in VWRL, then I went heavy on VUSA, and not sure how I want to balance it now." So, firstly, thanks for a great question. Um, Again, it's not financial advice, so please don't come back at me. But my personal opinion, I did the same thing. I focused very heavily on the S&P 500 because over the last 10 years or so, America has been performing very well. Now, I don't necessarily think that's a bad thing to do, because as I said, the American markets are performing very well, and you have got to remember that some of the top companies in the S&P 500 are actually worldwide companies. They're companies like Google, Facebook, Amazon, Tesla, etc. So on that side of the coin, I think the S&P 500 is still a great fund and a great index to track. The only downside to it is obviously some would argue, firstly, it's smaller in regards to its diversification because it's only 500 companies rather than the 3,600 or whatever is made up in VWRL. And secondly, you are putting all of your money into companies that are based in North America. Now, again, I don't know how much you want to pay attention to that second point, because a lot of those companies still trade worldwide and have customers all around the world. But the reason I swayed back to VWRL is just simply for ease. It's the fact that it is invested in 3,500 stocks. It is a real world tracker, so it is made up in the correct allocations, with sort of 60% in the US and around sort of 5% in the UK and so on. So personally, I choose to go now into a world tracker fund just to keep it sort of diversified as possible. In my opinion, I probably wouldn't be too stressed if I was in the VUSA either. I think I'd still sleep perfectly at night, but that's ultimately a decision that you're going to have to make, unfortunately. But thanks for a great question. Okay, so next question on the live comments. I've been asked, do you think? Sorry, it's by CBYB, and they asked, do you think paying more off the mortgage or invest more? So this is a big argument or a big discussion in my current household. Personally, I think invest more, but my partner thinks pay off the mortgage. So I think it's all down to personal preference, really. I understand both sides of the argument. I understand that right now interest rates are very, very low, and arguably we can get better returns in the stock market by investing in a low cost index fund. However, I understand my partner's point of view, where she thinks that obviously what gives us greater sort of rest at night than knowing that our house and our home is paid for. So I think this is one of those that unfortunately is completely down to personal preference. I can tell you that in my household we're split. We're on the fence. One is invest more, one is pay off a mortgage. To be honest, we're doing both. So we've made a happy medium and we are making small overpayments on our mortgage, but we also are investing too. So I hope that answers your question. Maybe if you guys watching, could you let me know what you do? Are you overpaying your mortgage right now with interest rates so low? I'll be really interested in hearing your answer. So I'm going to head back over onto the questions I've got lined up, the viewer questions, and then I can see we've got another one coming from Mid Finance, so we'll head over there in a second. So the next question is from Susie, and she said, "Great video. Will you keep going after the year has ended?" So for some of you, this question may not make sense. This was wrote on my magic formula investing videos. So for any of you that don't know, basically I'm doing this sort of mini experiment based on a stock screener portfolio made by Joel Greenblatt, a hedge fund manager, who claims by using this stock screener you can outperform index funds. Now, this screener helps you look for stocks that are undervalued in their opinion according to two main metrics and key ratios sort of thing. You can tell I don't invest a lot in individual stocks. So the question is based around, will I be continuing on with that investment? And the answer is yes. So the book states that for the portfolio to work and outperform the index funds as expected, you need to give it at least 3 to 5 years. So although I said it was a 12-month experiment, I was committing to sharing the videos for 12 months on YouTube, but I certainly will be investing well after the 12-month period. For any of you that want to go and check out those videos, please do head over to my channel. Don't forget you can hit the subscribe button if you want to. We are buying 2 new stocks every month. We're putting £100 into the 2 stocks, so £50 in each, and we're seeing how they do. It's an experiment. We don't know if they're going to do good. We don't know if they're going to do bad. Last time I checked, it was about 18% up the portfolio. I'm soon to be entering into my 12th month when I start selling some of the stocks. So yeah, make sure you come and join me over on the channel. So back over onto the comments. So before I go on to Amid Finance, we had our first comment on whether or not to pay off the mortgage, overpay or not. Trade M says she concentrates on overpaying her mortgage, but she also invests too. So it sounds like she's doing the best of both worlds as well. So back to Amid Finance. So do you think the magic formula can beat the market? So this is about the videos that I was just speaking about. So honestly, no, I don't. I think that you cannot go far wrong investing in a low cost world tracker. And there's all these different statements. There's the sort of this £1 million or bet that Warren Buffett made with that hedge fund manager, and I really do think it's quite difficult to beat an index fund, especially over the long term. I'm really interested to see if it does do well and if it would have outperformed. I'm actually looking at a way to cross-reference my results with if I'd invested the same amounts on the same days. So if any of you have any ideas of how I can find a website that allows me to find what something like an S&P tracker would have returned by investing on the exact dates that I bought the stocks for the magic formula, please let me know, because I would be very grateful. But right now, I don't believe it is outperforming, because at the moment, like I said, I'm about 18% up in my magic formula portfolio, and I believe that over the last 11 months I probably could have made more than that in just a world tracker fund. So gonna head back over to my sort of user questions that I already had. So the first question I had was from Carewell Cleaning Services, and they said, as you stop doing inspections, how do you go about redoing tenancy agreements, or do you just do one then leave it? So what this is in regards to is one of my videos where I was speaking about managing my buy-to-let properties, and I explained that if I have a long-term tenant that is as good as gold, and every time I've done an inspection it is spotless, I slowly start reducing the amount of times I go back for inspections. And some of my longer term tenants, I actually don't inspect their properties at all anymore, which some of you may think is madness, but I think there's a big amount of trust, and ultimately they want to feel comfortable in their own home. and I feel like I can trust them. They've always looked after me, so I try and look after them. So the way I go about it is I do still redo the tenancy agreement. So I do a new 12-month tenancy agreement each time it is due for renewal. So I know some people may well let it go into a rolling monthly contract, which automatically happens if you don't re-sign a new AST tenancy agreement. But I actually get a new one signed. Um, so it's personal preference, you know. Some people may think it's better off going into a rolling monthly contract. Maybe some of you guys can write in the comments box what you do if you've got buy-to-let properties. But the advantage of re-signing a new AST is I go round there to get it signed, so it gives me a chance to do a little mini inspection and pop my head in and make sure everything's okay. So we're going to head over back to the live comments now. Okay, so Joe, one of my very regular listeners, Joe says, "Hi Gary, regarding your own 5 rentals, are they all or some flats or a house? Are they leases, long or short, and what do you intend to do once these leases drop to say 50 years?" So awesome question, Joe, and there's some really interesting points to talk about there. So first part of the question, they're all flats, so they're all leasehold properties. Secondly, the leases are all long. Now, for some of you that may be asking, well, why does this really matter? Um, Basically, there's multiple reasons why it is quite important to make sure if you're buying a leasehold property, you get one with as long as lease as possible. As a lease starts reducing in term, it can become much more difficult to borrow money from the bank for that property and various other things. Basically, it becomes a more risky property almost. So whenever I invested, I always look for properties with at least 100 years on the lease. If not, what some of mine are actually were 199 years when I first bought them. So all of my properties are plus 100 years. I think some are plus 125, and like I said, 2 of them were 199. So I can't imagine I will still own them when any of the leases are down to 50 years. They say you should start worrying about sort of thinking about renewing the leases when they get down to about 70 or 80 years left on the lease. So I would certainly look at renewing the lease. There's a cost to doing this. And obviously I'll have to see how much that cost is and whether or not it makes sense. But if you are then coming to sell a property with a smaller number of years on the lease, it can greatly affect the value of the property. So this is something else I'd need to bear in mind. As I said, I've never had to renew a lease term. I have heard of a friend that had to do it, and I believe it cost them about £10,000 to extend it. And I seem to remember it got them back up to a 99-year lease. But if any of you have any sort of experience or comments about renewing leases, please bang them in the comments box, because I love getting the conversation going and talking about it. So yeah, thanks for a great question, Joe. So next up, Trade M says, "I love those videos. I saw that pop in. It was when we were talking about the Magic Formula videos. So if anyone wants to check them out, they're over on the channel." Katie just commented saying the cost of a lease extension would also make yields lower, I would imagine, and the cost will be more when you get below 82 years left. So there we go. It sounds like she knows exactly what she's speaking about. So yeah, under 82 years, you're going to start worrying about the cost of renewing your lease and sort of extending your lease, which can be a costly process. And yes, I would imagine that when you say it will also make yields lower, are you talking about rental yields lower? Because if so, I don't quite understand how you're saying it will lower rental yields. Maybe I'm not understanding your statement, but yeah, 82 years or less, basically, Katie's saying. So while we're waiting to see if any more comments come into the live comments box, we're going to head back over to the questions that I had already set up. This one's from Ewan, and they ask, quick question, Gary, why do you go for this one if it's not an accumulator? So this is when we talk about VWRL, which, as we've already spoken about tonight, is one of my main funds. So I've already previously mentioned why I speak about this, why I sort of invest in this fund rather than an accumulating fund. due to the fact that, firstly, it was a fund that one of my sort of fire bloggers that I was reading invested in, due to the fact it was slightly lower fees, and due to the fact that it slightly outperformed the global all cap fund. And the final thing I would say to this point, Ewan, is, to be honest, I do, and I know I shouldn't, I do log into my Vanguard account regularly, so it doesn't bother me too much the fact that I just have to reinvest it. I'm quite a nerd and I really enjoy logging into my Vanguard and taking a look and seeing how the performance is going. And I do get quite a lot of pleasure almost at seeing the dividends come in and reinvesting them. It gives me a sense of achievement and a sense of sort of tracking the progress. I completely understand the advantages of an accumulating fund and the fact that that money is just always automatically working for you, and it allows you to take a real step back. So if that suits you, I think that's a perfect fund to go for. So on to the next question that's been sent in. This one was by Trade M, who's on the live tonight. And she says, what's my opinion on repayment vs interest only mortgages for rental properties? So this is one of those that is going to give a real sort of divide probably in viewers, and that is because some will think repayment and some will think interest only. So to give you my story, I started repayment, and that was because I was encouraged by my dad that debt is bad and you should concentrate on paying off debt as quickly as possible. And I think we'd all agree that's not bad advice, right? So all of my flats were on repayment mortgages. The problem with this is it brought a few problems. Firstly, it increased my monthly payment. So every month I had to find more money than if I were on an interest only mortgage. The reason being is, on an interest only mortgage, you, as the name states, you only pay the interest. On a repayment mortgage, you pay off the interest and you pay off some towards the capital. So your amounts are increased slightly. What this means, when you're getting paid rent, maybe this is not necessarily a problem. However, obviously, if you were ever in a void period where you had no tenant, you've got to find more of an amount to pay off that mortgage. Now, another advice, so basically it increases your cash flow by being interest only, because the difference between your mortgage payment and the difference between the amount of rent you receive is a bigger amount by not having to include part of that capital payment. So I hope I've explained that well enough. The next disadvantage of repayment is the fact that I lost my trail of thought for a second then, but the next disadvantage of repayment mortgage is you're putting more of your money into something that is, we've already spoken about, interest rates are quite low. So you're locking more of your money away in this property that if you weren't overpaying that capital, you could potentially keep that money out of the property and invest it again. And that is what many sort of property investors do. Instead of overpaying one property and paying off that capital, each time they're just paying the interest, and any extra money they're then saving and buying another property, and then they're doing the same process. So then they've got two properties that they're not paying capital on, and as much money as they're taking out, they're again buying another property, and before they know it, this process grows quicker and quicker and quicker, and that is going to compound, just like compound growth in index funds. That is going to grow quicker and quicker and quicker until eventually you can probably be buying almost a property every single year, if not multiple properties a year. And this is how many professional investors are doing it. Now, I must just quickly say, final point to this question. To some of you, it may not be your cup of tea being sort of in debt up to your eyeballs on multiple properties, and I don't think you'd be stupid to have that opinion. So if a repayment mortgage suits you better, then I can't argue that is what makes you sleep better at night. But I would probably say probably 95% of buy-to-let investors go down the route of interest only for the reasons that I've just explained. So I hope that answers your question a bit, Em. I'm sorry I sort of went round the houses a bit, but there's so many different parts to that question. We could probably actually have a whole night all about just that one question. So just quickly, I'm going to head back over onto the live comments. I can see they're all coming in and we're getting a bit of a conversation going, which is great. Katie said yes. So, i.e., you've paid more on the property, so your return would be less. Yeah, you're right. So obviously, if you're having to pay to extend your lease, that's more of your profit that's set up to pay that. So yes, definitely. Amid Finance says, what do you think is better, investing in real estate with or without debt? Personally, I've now knowing what I know now, I probably think investing in real estate with debt. So with an interest-only mortgage, like we were just speaking about, the reason being is the barrier to entry is much lower. Obviously, to buy a whole property for cash, you're going to need a whole lot more savings, which not everyone can get. So we can use other people's money, i.e., the bank, to help us buy a property. And if say, let's say, for example, we've got 25% of our money in their property, and 75% of the money is the bank's. That is a whole lot of money that we didn't have to find. So yeah, personally, my personal opinion is probably to buy with debt. But what's your opinion? Please leave them in the comments box. I'd be really interested to hear. Just a little caveat there. I actually purchased my first buy to let property for cash. So I'm doing everything that I'm telling you now that I shouldn't have done. But my first property I bought for cash. I had no mortgage on. And then I also had repayment mortgages. So I'm not really my own prime student, really, doing the things that I'm sort of talking about now. A few more comments in the comments box before we head over to the next question that's been sent in. So Katie said less. I'm sorry, I'm not entirely sure what that's regarding now, but I'm sure it makes sense in the conversation. Trade M says haha same. Alison says, do you invest a certain percentage of your income in ETFs? Plus, are planning on getting another buy to let, please? So thanks for an awesome question, Alison. So to answer your question, I invest right now. I invest 100% of my income from my business in ETFs and index funds. So technically, I am at what most people call FIRE. So everything I earn, I invest. Now, the thing you have to remember is obviously I do earn elsewhere. I earn from my rental properties over here too. So I'm living off the money. My hands are not in it. I'm living off the money out of my rental properties. And now what that means is all of the money I make over here from my business, I'm investing, and it's going straight off into index funds and ETFs. So yes, technically I am what most people would call financially independent, retire early. I'm at FIRE basically. What I must say there, don't get too excited. It is a what we know as a lean FIRE. So I couldn't be going off on lavish holidays to the Maldives and playing golf twice a week. It'd be a fairly okay retirement, but not the most exciting one. And the problem is, obviously, by relying on these rental properties, I'm relying on them always being full, always having tenants, and always paying me an income. Now, we're going to have void periods. We're going to have periods where maybe a boiler goes bang or something, So I'm trying to build this much fatter pot over here by investing all of my income from my business into index funds and ETFs. Am I planning on buying another buy to let right now? No, I'm not right now. And the reason being is I sort of had a little pit stop in life a while back, and I realized that all of my investments and money were just in property. And now, by no means do I think this is necessarily a bad thing, but it did worry me a bit that I was so over invested just in property. I had no other investments barely any other investments to show for it. So the reason I'm not planning on getting another buy to let right now, firstly, is because of that, because I was a bit worried that I was over over what's the word? I was over committed just to one sort of strategy. So right now I'm trying to get the investments in the index funds and other things sort of up a bit. And then I certainly will consider buy to lets again. The second reason that right now I'm not buying a buy to let is in the areas that I look to buy, I think rates are quite high right now. I think house prices are very expensive. Personally, and I appreciate I might get some stick for this, but personally, I can see us having a little drop in the housing market and the stock market. But who knows? I've been saying that for the last year and a bit with since COVID hit, so we will see. Glenn says interest only as it's an investment. So you can see that quite a lot of property people will say interest only. Trade M says good point, Glenn, and then she says you did thanks a nice one on round the houses. I didn't even mean that pun, so I'm quite impressed with myself on what a comedy genius I am. So anyway, we're going to head quickly onto another viewer question that was sent in, and then we're going to head back over onto the live comments in just a couple of seconds. So Matthew said, do you put more into your SIP or your ISA? I'm not sure which option is more beneficial. So Matthew, thanks for an awesome question. And the answer is I do a bit of both, and I do different methods with different things. So I know I haven't answered your question very well. So let me try and explain that a bit better. So I was investing all of my money into my ISA, and I didn't have a pension, I didn't have a SIP, so I probably just got a load of people's jaw hit the ground. But I always saw my pension as my properties. My properties was always going to be my sort of nest egg, you know. And that was until I started learning more about pensions and understanding the real benefits of having a pension. The big one being the big tax savings available, especially as a self employed limited company. There is some big tax savings. So recently, I've started concentrating a lot more on getting money into my pension. Um, the problem with this is because part of my sort of fire plan is to retire early. I don't want 100% of my money locked up in a pension, tied up until a certain age before I can draw it out. So I'm having to right now work out what is the right amount to get in my pension pot and what is the right amount to get in my ISA pot. The reason being is, let's say, for example, I retire in 10 years' time, I might then have a 15-year gap until I can take from this pension. So I need something to fund those 15 years. Now, of course, I'm going to have my buy-to-let properties and my rental income, but it's important to me to have an ISA to fill up this gap while I'm waiting to receive my pension. So right now, I know it doesn't answer your question amazingly straightforward, but I'm investing in both and I'm trying to find a happy balance. At the moment, I'm investing a lot more into my SIP because it makes sense to do it from my company, due to the tax implications, due to the fact that I can save on tax. But I will again start topping up my ISA too, because I need to bridge that gap from retirement to reaching being able to access my pension. So thanks for a wicked question, Matthew, and I hope I answered it okay. So next up, over to the live comments. Ian says, hi Gary, I'm thinking about putting the full ISA allowance into the Vanguard US equity fund, and I'm going forward maxing it out every year to make the most of the compounding effect. Is this a good idea? So Ian, thank you so much for your comment. First of all, I must just say, I can't give you financial advice, so please just respect that this is my opinion and what I would do. So firstly, I think you personally, I wouldn't think twice about maxing out my ISA, and I do exactly that every single year. So that part of the question, I can only give my opinion that yes, it's certainly something I would do, and yes, personally, I would look at a low cost diversified index fund. Now, earlier in this live chat, we were talking about whether or not to invest in US equities or a world tracker, and unfortunately, my answer is going to be you need to make that decision of what fund you think suits you best. For me personally, it's VWRL, which is a world tracker fund. For many others, it's the FTSE Global All Cap Equity Index Fund, and for some, it's the USA, the North American S&P 500 tracker. But to answer your question, without sort of trying to give any advice, for me personally, it's a no-brainer maxing your ISA out if you can, and continuing to do that and taking advantage of those tax allowances that we're given. And it's a no-brainer to be investing in a low-cost index fund, which is going to keep our costs down. It's going to diversify our investments, and hopefully it's going to make us all very wealthy people one day, and we'll be all going out for a beer together. So one more question over in the live comments before I head back to the previously asked questions is from Connor. So hi Connor, I haven't heard from you for a while, mate. It's nice to see you. What's your opinion on ARK and their ETFs? Honest answer, I don't know anything about ARK. I've heard of them, but I don't know anything about them. So I'm really sorry, mate, but I can't give you any opinion on them. But has anyone got any opinions on that? Please leave them in the comments box, and let's all tell Connor what our thoughts are. Obviously, this is a community for us to all share our opinions and thoughts. Okay, so on to the next question that was sent in by a viewer. We are on to question 8 of 10. Wow, this night is going quick. No, question 9 of 10, blimey. So question 9 of 10 is from David, and that is very small on my screen, so let me just maximize it. David says, is it okay to invest in VWRL through, say, Trading 212, or is it best to do it through Vanguard itself? So, first, to say you can indeed invest in VWRL on Trading 212. Secondly, you can invest in VWRP, which is the accumulating version of VWRL. You can certainly do that on FreeTrade, and I believe you can do it on Trading 212 as well. For me personally, I concentrate on investing all my major amounts of money on Vanguard just purely because of the size and the sort of I trust that company. It's been around for a long time. I think it was set up in 1975, I believe. So it's a long, well established company with billions and billions of pounds invested all around the globe. I'm not saying Trading 212 isn't a fantastic company, but it is a much newer company and it just doesn't have the same sort of track record and sort of big worldwide sort of hold that Vanguard does. For any of you in this fire community like me, you know Vanguard have a special place in our heart, and personally I choose to pay a small platform fee to hold my funds with Vanguard. But thanks for a great question, David. So heading back over onto the live comments, Katie says, does inflation eat up some of the debt as well if you pay it off later? So that's a reason to buy with a mortgage and pay interest only. So Katie, yes, you are correct. You actually have reminded me of one of the biggest advantages of interest only mortgages that I didn't say. So thank you. So yes, correct. So what we mean by this, technically inflation, technically the pound coin in your pocket or dollar coin in your pocket has been going down in value every single year due to inflation. So the age-old story that was on TradeM's Instagram recently is about Freddo bars. So do you remember when Freddo bars used to be like what 5p or 10p? They're now like 25p or something mad, probably about a pound now actually. But that is inflation basically. It's the cost of goods are going up. Now, the argument is, let's say we buy a property down here at £100,000. Over time, that property is going to increase in value, we hope. Now, they say a property doubles in value roughly every 10 years over the history of the property market. Whether or not that will carry on, who knows? But let's say that investment property keeps going up. Okay, so let's say now our property in 20 years' time is worth, well, if it doubles every 10 years, it doubled over 10 years to 200,000, and then it would have doubled again to 400,000. So it would have gone from 100,000 down here. I need to find my hands. 100,000 to 400,000. However, let's imagine that when we borrowed our mortgage, we were on a 75-25. So we personally put in 25%. So we would have put in 25 grand. Now, when we come to pay off our interest only mortgage, our property, we still owe 25 grand. We still owe the same amount because we basically we never made any overpayment towards the capital. However, the exciting thing is the property is no longer worth £100,000. It's now worth £400,000. So that growth has paid off our debt easily and given us a huge amount of profit too. So that is another great exciting thing about interest only mortgages. Now, of course, you still would have had this if you paid off your capital too, but the argument is rather than making those capital overpayments, we were investing those capital overpayments into more properties maybe. Now, I know it's not for everyone, and I believe Joe, who's on tonight, their opinion is to pay off and overpay mortgages. So everyone's different, and I know certainly my partner's opinion is to overpay a mortgage too. So each to their own, and like I said, I don't think you're going too far wrong by doing either. Okay, so next question is from Ryan. And Ryan says, Gary, based on everything you've said, why is it ranked 5 out of 7 for risk? Seems one of the safer investments to me due to how diverse it is. So again, I need to explain this question so it makes sense. This was based on one of my videos about VWRL. So for any of you that don't know, VWRL is rated a 5 out of 7. VWRL is rated a 5 out of 7 in risk. And the reason it is rated so highly in risk is the fact it is 100% in equities. Now, for many people, this is a very risky approach. And in my opinion, maybe I'm the odd one out, but I don't personally see this as a risk. I see this as a volatile fund. What this means is because we're 100% stocks, when the market's going up and down, it's going to go up and down much greater than if we had those bonds to smooth the ride a little bit. However, in my opinion, it may go up and down, but it goes up and down and it goes up over time. And we can only look at the past, we can only look at history, and the stock market has a tendency of increasing basically. Part of this is due to inflation and companies being able to charge more for their products and services. So who knows what's going to happen, but all we can say is what has happened in the past, and the stock market trends upwards over the long term. You can look at a short-term graph of an index, let's say the S&P, and over the short term it can look like a really scary ride, can't it? It can look like a roller coaster at your favorite theme park. But if we look at the 10-year investing horizon, even, it actually becomes, I'm doing it the wrong way, it actually becomes a fairly straight line upwards, albeit a wiggly line upwards, but it does look like a straight line upwards. So thanks for a great question, Ryan. But yeah, really, I think it's them being safe and really trying to protect their clients, as not everyone feels comfortable investing in something that is going to be so volatile. And that is where I think maybe their wording is slightly wrong. I would call the fund 5 out of 7 on volatility rather than risk, providing you have a long-term horizon of investing. And they do explain this on their website. All of this information can be found. And they do state that if you invest in something like a life strategy 100% equity, you should have a 10-year plus investing horizon in front of you. And that is something that I really want to drill home, that personally my approach is low cost index investing over the long term low cost index fund investing. And I believe if we do that over a long term period, we keep buying in with our paychecks each month, we're going to be in a very good place in 20 or 30 years, and we're all going to be buying beers and having a great time together. So we are going to head back over onto the live comments. Quite a few's come up. Let's have a look. So Connor says, also, have you seen any of the crypto ETFs that are being created? They look pretty good. I have seen them. To be truly honest with you, Connor, I avoid crypto because I don't understand it well enough. So that's due to my arrogance, basically, of not understanding cryptocurrency well enough. They certainly have performed very well, and some of the highest performing ETFs and index funds, or ETFs certainly, have been like the Bitcoin ETFs, etc. But I just simply don't understand it well enough to invest a large proportion of my money. I do have a small amount in cryptocurrencies, but it is such a small amount that ultimately it wouldn't be the end of the world if I lost it, because I just don't understand it well enough. But who knows if cryptocurrencies is the future? And if you do know, please write it in the comments box so I can follow what you're doing. Amid Finance says there is a stock for a Coinbase exchange. It is not an ETF exactly, but it forms like a crypto market. Thanks for sharing that, Amid Finance. Connor says, good to see you too, Gary. Have a look at ARK. Their returns have been crazy the past couple of years, and their CEO, Kathy Wood, is incredibly smart. Yeah, I've heard a lot of things about Kathy, and I heard how well one of their funds did. I believe it was about 50 or 60% up. It may have even been more than that. I'm sure someone will correct me in the comments box. Amid Finance says ARK is heavily invested in Tesla, which is crazy overvalued now. When Tesla goes down, ARK goes down. So there's a really interesting point of view about ARK. Connor says, I agree, Tesla is overvalued, but they have a diversified portfolio, so it won't be too much of a problem. I'm sure they have good reasoning to invest in Tesla. So quite an interesting conversation going on about ARK. Make sure you join in the comments box. So I can see Ian's wrote a comment. We're just going to answer the final question. No, we're not. That was the final question from Ryan. So we're going to head back over to Ian's question in the live comments box. So Ian says, if I maxed out my ISA allowance, what should I do with the money I save until I invest into my ISA again? Great question, Ian. So, again, it's not financial advice, I must say that. What would I do personally? I would probably do something very boring and put it in premium bonds. And I know this is the most unromantic and the most boring way of investing money, and really the reason I would do that is it's safe. It guarantees that my money is still going to be exactly that amount in a year's time, or whenever the next April comes for your next ISA allowance, is still going to be the same amount at least, and you do have a chance of winning on the premium bonds. I do exactly this, so I have some of my emergency fund in premium bonds, and I can see Joe's just said, what do you think about investing in premium bonds, dead money or what? So I have to agree with Joe in some respects. It is going to be dead money. It's going to be dead money just like keeping the money in the bank account. But the only thing I would say with premium bonds, at least you have the chance of winning a sum of money. The reason I would personally do something like that is you need the money in such a short term horizon. You know, you're talking, let's say you top up, let's say you use up all your ISA allowance this month, we're in June, you're going to need that money again in 10 months time, come April the 1st, or April the 6th, sorry, you're going to need that next sum of money. So we're talking what, nine and a bit months away. I don't think I could risk putting it in like a general account on Vanguard, due to the fact that if I invested that amount and there was a big drop in the market, I can't then use that money to put it into my ISA because it's dropped so much. So yeah, personally for me it'd be premium bonds, but it's a very unromantic, and as Joe said, it can be dead money and you may not win a penny on the premium bonds, but you're not going to get a lot in the bank account anyway. My personal opinion is I'd rather get nothing on premium bonds with the chance to win some money than get nothing in a bank account. So that's my opinion, Ian. But of course, what you do is up to you. But if you decide to do something different, please let us know, because I'm always interested to hear what you guys are doing. But for me, I'd just be a bit too worried about sort of volatility of putting it into anything more risky when I know I need that money again in such a short space of time. So I hope I explained that well enough, Ian. I'm not ignoring comments, but I can see Joe say, okay, so have you ever won? So yes, I have. I've been doing it now for 6 months and I've won 2 of the months, £25. So it's not amazing. I've made £50 on the amount. I have £15,000 in there. So I've made £50 off £15,000. So the rate of interest is not amazing, but the rate of interest I would have got from the bank account probably wouldn't have been amazing either. And every month I've got the chance of winning $1 million, as Del Boy would say. So Katie suggested, or you could have it in a general account. So as correct as Katie is, you could do that, but obviously it introduces a risk of and volatility risk basically. So it depends how comfortable you feel about that. That in 10 months time or whenever you need that allowance, your money could have dropped greatly in value. So Antonio says, hi there, I've invested in a couple of index funds. However, I find it hard to know and find its daily performance other than the Vanguard website. Could you suggest other sources of said information? Of course I can. So thanks for a great question. So firstly, you can actually Google most of the ETFs. So if you actually type in the ticker, you can, for example, type in LON and then dot dot. LON stands for London Stock Exchange, and you could write in VWRL, which is a ticker symbol for the FTSE All World ETF, and you will see a performance graph there, and you can watch it live if you want to, which I do sometimes. I probably shouldn't admit how cool I am, but I do that. Secondly, there is an app called, I'm going to find my phone, 2 seconds. The app is called, 2 seconds, CNBC News. So you can track certain index funds on there, and you can set it for them to be your sort of favorite index funds, and you can see their performance on that app. Another way to track it is on Morningstar website. You can type in an index fund and you can see loads of information about them. And one of the tabs is for performance. The good thing about the performance charts on Morningstar is there is the option to compare to. So sometimes it's quite interesting to see how certain index funds have compared over 1 year, 3 years, 5 years, and 10 years, and you can see how they've performed over that past period and whether or not that sort of suits what you're picking. Maybe you'll see that a particular index fund has performed much better. So I hope that is slightly helpful. Please keep firing your questions away. To be honest, I'm all out of questions that viewers have sent in prior to tonight's live. So unless I get any other questions in the comments box, it will be the evening over already, which is a real shame. So fire over any questions you have. Amid Finance says, which books would you recommend for investing in individual stocks? So I've only read 2 books, well, 1.5 books on investing in individual stocks. The reason being is it's not really what I do. So the first book I read with regards to investing in individual stocks is The Little Book That Still Beats the Market by Joel Greenblatt. Now, this book can be found in the description of this video. There's a link below, so if you wanted to go and check that book out, you can find it there. And this book is to do with the stock screener that I was talking about earlier for any of you that were on the live. But basically, Joel Greenblatt has created this screener that tries finding undervalued stocks by a couple of certain metrics it's looking at. It's an interesting read, and I've certainly found it interesting trying this method of investing. It's supposedly this value investing, and I'm going to be very interested in seeing how this method performs. The second book I've read, I'm struggling to remember the name of it now. And this is the one that I've not read all the way through. So let me just find it on my phone. 2 seconds, guys. It's the really famous book on investing in individual stocks. I just need to find it. But the reason, while I'm trying to look for the name of the book, the reason I haven't read it all is, to be honest, it's a really dry, heavy read, and I'm really struggling to get into it and get through it. It's called The Intelligent Investor by Benjamin Graham, and I know it has a huge sort of write-ups saying how incredible the book is, but to me it's just a bit heavy, and I'm someone that really enjoys learning about finance and learning about investing, but I just find it a bit heavy, and some of it is just a bit over my head, that I'm just really struggling to commit to that book and keep it going. What books have you guys read about investing in individual stocks? And maybe if any of you want to just put in your top finance book that you'd recommend. I'd be interested to hear what you guys think. So Katie's speaking about premium bonds, and she said, I've won £25 since March. Joe, my mum and dad have won £125 in the last year. So it could be worse, but definitely could be better. So there you go. So premium bonds, they can earn you a little bit. They may earn you nothing, but who knows what we're earning in the bank account right now. Is it about 0.01% or something? It's not a lot. So I am all caught up with my questions. So I'm going to give it sort of 10 to 20 seconds to see if any more questions come in. While I'm waiting to see if any more questions come in, I'm just going to sort of give you a quick update about the channel. I just wanted to say thank you so much. We're just over a year in now. I've got almost 2,500 subscribers. I'm probably going to have hit 100,000 views this evening. So I've now earned 100,000 views as a YouTube channel over the last year, which is incredible. You think how many people 100,000 people are. Well, you think that's probably not strictly true because it's views rather than unique viewers. But anyway, 100,000, it's incredible. So thank you all so much for your support. I do put a lot of time and effort and into this YouTube channel, and it means so much that you guys all log on and join me, and we can have these fun chats about finance. I really enjoy chatting to you. I always find it so interesting to hear what you guys are doing, finding out about ARK Invest with what Connor's talking about, and cryptocurrencies and individual stocks and all these different things, and hearing all of these different ideas. So I just wanted to say thank you so much. So I haven't had any more questions, so it looks like that is going to be night over. So thank you all so much for joining me tonight on my what is it, 4th live, I think. I hope you're all having a wonderful summer. Hopefully, COVID is on its way out, and I'll see you. 1 second, Joe's just answered the question. So let's hear about the house. Are you going to sell it once it's done? Lots still to talk about. So, Joe, um, just to let you all know what Joe's speaking about, I've been sharing my house renovation updates on the YouTube channel, and it's been a little while since I last shared an update. And the reason being is we got quite a lot way through with knocking the wall down and plastering. That was quite a big update, and then actually from sort of plastering and painting, not much really changes. That it would have been a very interesting update. The exciting thing is the kitchen actually went in 2 weeks ago, and it's just being finished off at the moment. The bathroom is going in next week, and various other things are happening. The floor layer actually come this morning to take a look. So I believe the next update is going to be so much more exciting because it's actually going to start looking like a house. I was really worried about sharing an update where it just looked pretty much the same as the last update, and you would have been like, what the hell have you been doing? It has been taking its time, and the reason being is we've actually only been managing to get there at weekends due to the distance to the property that we live from the property. But it is coming along really well, Joe. Thanks for asking. I'm super excited to share the update of the kitchen. I suppose I'm actually holding out to get those last few finishing touches done before I share the update, because I'd really love you to get the full impression of what it's looking like. But it's looking incredible, and I'm so excited to share the update with you. Amid Finance says, thank you. I think that meant to say for your answers, Gary. Good luck with your channel, and that's really kind of you. I presume you've got a channel too by your name, so good luck with yours too. So anyway, I believe we're night over. So thank you all for joining me. Thank you all for your support over the last year. And I will see you on another video very soon. And I promise my house renovation update is coming really